Hello, now we're doing part two. We did part one. We did what do you record when you buy goods for resale. Now we're going to look at what do you do when you actually sell the goods. What are the journal entries? Now again, our focus is between the retailer and the buyer. In managerial account, you cover the manufacturing side. And that's where you're getting raw materials and building a product. Here we're taking finished products and we're selling them to customers. So when a company buys goods to sell, there are two types of transactions. We talked about in part one what happens when the goods are purchased, i.e., they are treated as an asset till they're sold. And part two, now we're going to look at what happens when you sell goods purchased for resale. So again, we talked there are two inventory types. We focus on perpetual, which is the inventory account is adjusted every time there is a transaction, and particularly if there's a sale. We're going to focus on three primary entries. What happens when there's a sell? What happens when you sell an account and they're eligible for sales discounts? And what do you do with sales returns? Now, what if you sell something and that's cash and there's 10 items? So what you want to do first, particularly since this is perpetual inventory system, is we want to first book the revenue. And the cash would be 10 times 150 because we said these were cash sales. And the offset would be sales revenue. Now remember, you still have to book the cost because you have to matching principle. You have to match the expenses and the revenues. So cost of goods sold, again, is an expense account. That's going to go on the income statement. And then we're going to reduce our inventory. When a sale is made, you must transfer out the cost from the inventory, which is an asset, to cost of goods sold, which is an expense. So it's going from the balance sheet to the income statement. Now, what happens if you sell on account? Well, remember, on account means no cash changed hands. And in this case, what we have, we'll read the terms. We sold 20 items. We know that we're going to get 2% if we pay within 15 days, but we have to pay the balance in 30. And we have shipping terms FOB destination, which means the seller has to pay because we own them until they get them. So the sales discount, the price has to be adjusted for the discount since we use the net method. But we also have to book the cost of goods sold. Now, the delivery charges are going to be treated as delivery expense. They do not go to inventory because they're treated as a selling expense. That's called freight out. So remember, freight out is associated with selling, is treated as a selling expense. It is not part of the inventory cost. Only when you buy goods is it included as part of inventory because it's the cost of obtaining that inventory. Okay, under the new revenue recognition rules associated with sale returns and allowances, we now have to set up two reserves. The first is called estimated refund liability. It's based on an estimate for the amount that is expected to be refunded to customers. This is shown under the current liabilities on the balance sheet and follows inventory. It can be recorded based on each sale or at the end of the accounting period. The second account we have to set up is a reserve for estimated inventory returns. It's an estimate associated with the sales returns for the cost of the goods sold, shown under current assets following inventory on the balance sheet. Oh, I'm sorry. Estimated refund liability does not follow inventory on the balance sheet because it's a liability. So that would be as part of current liabilities. So rehash this. Estimated refund liability is treated as a current liability on the balance sheet. Estimated inventory returns is treated as an asset on the balance sheet, current, and it follows inventory. So now let's take a look at some examples. We sold 100 items at 150 each at a cost of $100. So we first book the revenue. Then we book the cost of goods sold. And now we believe that we're going to get 10% of these sales back based on our history. or industry averages if we don't have a history. So then we're going to set up our estimated refund liability account, which is going to be in current liabilities on the balance sheet. And we're going to set up our estimated inventory return, and that is going to follow inventory on the balance sheet as part of current assets. So both of these reduce sales and reduce cost of goods sold. Now, what happens when you get a return? Remember, because you have set up a reserve based on estimated returns and allowance, when these transactions occur, they have no effect on the income statement. They only affect balance sheet accounts. So let's take a look at that. So in this example, we had 5 items returned at $150 each, and they had a cost of $100 each. So first, we're going to reduce our estimated refund liability, which is a balance sheet account, and our accounts receivable, which is also a balance sheet account. Then we're going to reduce our inventory, increase our inventory, because now we're going to put these back into inventory, assuming that they're still good. And we're going to reduce our estimated inventory returns current asset account. So that entry would be a wash. And again, remember, these are balance sheet accounts. Now, what happens when we have a sales allowance? We gave a customer, we said, just keep the goods and we'll mark off $200 off your account. What you will do is reduce estimated refund liability, reduce accounts receivable, but it has no effect on inventory or estimated inventory returns because we didn't get any merchandise back. And that ends this presentation. I hope that helps.